Hi there, welcome back to PTA. In this video, I'll walk you through the April 2026 income tax changes every UK taxpayer should understand.
Hello and welcome. In this briefing, with some great insights from the team at ProTax Accountant, we're going to tackle the really important UK tax changes heading our way for the 2026/27 tax year. Now, if you're a business owner or a company director, listen up, because these aren't just dry numbers. These are big shifts that are absolutely going to affect your bottom line. Getting ahead of them now, well, that's your best move.
All right, let's just jump straight in with a situation that I bet a lot of you will recognize. So picture this. Your business does just as well as last year, same profit, and you take home the same income. You'd think your tax bill would be the same too, right? Makes sense. But come the 2026/27 tax year, that's probably not going to be the case. Your tax bill is actually very likely to go up, even if your income doesn't budge. So let's get into exactly why that's happening, and more importantly, what you can do about it.
So here's our game plan. We'll kick off with the big picture, how the tax landscape is shifting. Then we'll zero in on the squeeze on your personal income. We'll also look at how the UK is becoming a bit divided by tax, cover some other really key changes for your business operations, and then, and this is the crucial part, we'll get into planning your strategy and what your next steps should be.
Okay, so what is this new reality for 2026/27 all about? You know, the biggest change isn't some crazy headline-grabbing new tax rate. Nope, it's something much quieter, more subtle. And it's a concept you're going to hear a lot about: fiscal drag. Fiscal drag. This is the one concept you really need to get your head around. And you know, the way it works is, well, it's pretty clever, really. The government isn't officially putting up tax rates. What they're doing instead is freezing the thresholds. So that's the income level where you start paying tax or where you jump into a higher bracket. By keeping those frozen, they get pretty much the same result as a tax hike. Think about it. As your wages go up, even if it's just to keep pace with inflation, more and more of your money gets pushed over that frozen line and into a higher tax bracket. It's basically a stealth tax increase, and it's the main thing driving all the changes we're about to talk about. Okay, so let's see how this all adds up to a direct squeeze on your income. This is where that theory of fiscal drag stops being a theory and becomes a very real cost to you as a business owner. It hits both your salary and any dividends you might be taking from your company. And right here, this slide, this is the engine of fiscal drag in action. Just look at those key numbers. The personal allowance, that's what you can earn before paying any tax. The higher rate threshold, and that very small dividend allowance, they're all frozen solid. They're not going up with inflation. And with this freeze now expected to last until at least 2031, it means any growth in your income over the next few years is just going to get taxed more heavily. Simple as that. But it's not just the frozen thresholds. On top of that, we've got a direct tax hike. So for any business owner out there who takes profits out as dividends, this is a big deal. Look at this. The rates for both basic and higher rate taxpayers are jumping by a full 2 percentage points. This just makes taking dividends more expensive than it was. And it means you absolutely 100% need to take a fresh look at your remuneration strategy.
Let's put some real numbers on this to see what it means. Say you're a higher rate taxpayer and you draw £20,000 in dividends. Okay, after that tiny £500 allowance, you're now paying an extra 2% on the other £19,500. A quick bit of math, that's an extra £390 in tax. Gone, straight out of your pocket. It's a really simple but powerful example of how these changes directly eat into your take-home pay.
All right, let's just zoom out for a second. The tax landscape isn't just changing, it's also kind of fracturing. We're seeing this growing split in how income tax is handled across the UK. And the differences between Scotland and the rest of the UK, well, they're becoming seriously important, especially for businesses that operate nationwide. I mean, just take a look at the complexity on this slide. On the left, you've got the system for England, Wales, and Northern Ireland. 3 bands. Pretty straightforward. But then, on the right, Scotland's got this much more complicated 6-band system. And it's not just that there are more bands. The higher rate kicks in earlier and at a higher percentage, and the very top rate is a full 3% higher. This creates some real headaches for things like payroll and hiring. And we're not talking about small change here. An employee earning £60,000 a year is going to have a significantly different amount in their bank account at the end of the month, depending on which side of the border they live. Now, as a business owner, this starts to affect everything, doesn't it? From negotiating salaries to deciding where you're going to base your staff, or even your entire business. Okay, let's switch gears a bit. We've talked about personal income, so now let's look at 3 critical changes that are going to affect the day-to-day running of your business. We're talking tax reporting, employee expenses, and what happens when you decide to sell company assets.
First up, making tax digital for income tax, or MTD. Now, this is a massive shift in how you do your compliance. From April 2026, if you're a contractor, a freelancer, or a landlord with an income over £50,000, you will have to use compatible software for all your records and send quarterly updates to HMRC. So, a professional tip for you here: the days of handing your accountant a shoebox full of receipts once a year, they are officially over. You need to get your systems and your software sorted out now to avoid a mad panic later.
Next up, a little something from the pandemic era is being put to bed. That ability for employees to claim a flat rate tax relief directly from HMRC just for working from home, that's being abolished. Now, the really important point here is that you, as the employer, can still make tax-free payments for legitimate home working expenses, but that automatic relief is gone. The responsibility kind of shifts, and you might need to have a look at your company's expense policies. Okay, now this next one is absolutely vital for anyone who's even thinking about selling their business or some significant assets. The capital gains tax rate for something called business asset disposal relief, which is a relief that massively lowers the tax you pay when you sell qualifying business assets, is jumping. It's going from 14% up to 18%. That is a huge increase that directly impacts the cash you'll actually receive from selling what might be your life's work. And that brings us to a really key piece of advice. You know, the difference between selling your business on the 5th of April versus the 6th of April 2026 is a 4 percentage point difference in your tax bill. Let that sink in. On, say, the sale of a £500,000 business, that's an extra $20,000 in tax. Poof, gone. So what this means is, if you're even thinking about a sale, the timing has now become a critical strategic decision. And it's one that requires you to start planning right now. So we've laid out the challenges, right? We've got fiscal drag, higher taxes on your dividends and asset sales, all this regional complexity, and new reporting rules. I know, it can seem a bit overwhelming, but the key thing here is to shift from being reactive to being proactive. So let's start talking about how you can build your strategy for 2026/27. All right, here it is, your strategic checklist. You need to be asking yourself these questions. First, is the way I'm taking profits out of my business still the most tax-efficient way to do it? Second, have I really looked at my regional tax exposure, especially for my staff? Third, are my accounting systems 100% ready for making tax digital? Fourth, if I'm thinking about a sale, have I thought about that critical timing? And last but not least, are my employee expense policies actually up to date? So as we've seen, getting through this new landscape is really going to take some careful planning. So let's talk about how you can take all this information and turn it into a specific, tailored strategy that actually works for your business. So to wrap it all up, when you combine the effective fiscal drag with these targeted tax rises on your investments and assets, and this growing regional complexity, it means that just carrying on with business as usual probably isn't the smartest or most efficient option anymore. Being proactive and getting professional tax planning has honestly never been more important for protecting your wealth.
Okay, before we sign off, a very important disclaimer. What we've talked about today is for general guidance, based on info from Pro Tax Accountant. But tax laws are really complex. They can change, and of course, your business is unique. So please, always, always get professional advice that's tailored specifically to you before you make any big financial decisions. So, if anything we've discussed today has raised some questions or maybe even highlighted an opportunity for you, then we'd really encourage you to get in touch with Pro Tax Accountant for that tailored advice. Their team can help you navigate the 2026-27 tax year with confidence and really secure your business's financial future. All their contact details are right there on the screen for you now.
And one last thing. To make sure you stay on top of crucial updates just like these, why not subscribe to the Pro Tax Accountant channel? They put out regular expert insights to help you and your business stay ahead of the game. Thanks so much for watching.